Let's look at these past picks. July 24th of last year is when David made these. We'll start with the loser here that you're out of Concho Resources. What was the thinking, and how quickly did you get out as the market started to turn on you?
That's a great question. So coming into the summer last year, 40% of our portfolios were in producers, service companies, and infrastructure pipelines, largely. And that was roughly split about 10% producers and service companies, about 30% pipelines. July the 6th, the model that we use that tracks breadth in the energy producers turned lower. That was just ahead of the price of oil at $106 a barrel. So that means for us, when breadth starts to contract, or the percentage of stocks performing well starts to roll over, that means for us we can't add new positions within that sector, and we tighten up the stop losses that we use. Over the course of July and August, all of our producers really had to come out of the portfolio. And they didn't come out because we thought price was going to $40. We just got stopped out. Mm-hmm. And then eventually through the fall, the pipelines came out of the portfolio. So you can have a great company in the wrong sector and you're not going to make money. And very clearly, there was a transition that took place, and our rotation was towards, the consumer and towards technology and towards healthcare.
And so, in other words, you got out in time before the real damage began.
We use point and figure price charts. They help us to recognize inflection points. I'm okay taking little losses. We're not okay taking big losses. Actually, right. The clients aren't okay taking big losses.
I'm sure. Okay, next up here is Apple, and I just wanted to, if you could comment on the recent activity, down 5 straight sessions, near the 200-day moving average. Anything to be concerned about here?
I think this is getting caught up in what's going on in the market. You've got a very clearly rising moving averages. Stock has been basically trading in a range of 120 to 134, going back about 3 months. We've got earnings coming up. We're going to get a clearer picture there. We're going to get a clearer picture in Greece. 3 types of names get sold when people get nervous. The ones that haven't been working, people ditch those. Second, they sell the stuff they've got big profits in because they're liquid and they feel good to take a profit. And I think that this is where Apple comes in. And then the third are those that have been languishing, and obviously it doesn't fit into this camp. So I think that in the last couple of days and some of this volatility, you've seen some of the market leaders get hit a little bit. Technically not broken at all.
And we will move along to Walt Disney here, up by 35%. We've had some guests say, one the other day just said, if you want a U.S. growth company and you want to put it away for 10 years, this could be it.
Yeah, I think I've used this 3 times as a top pick over the last 2 years. And, when consumers have a bit more money, they spend it on travel, they spend it on going to the movies, and Disney happens to be in the center of all of that. And they just continue to churn out product. They continue to come with new content. Their theme parks are doing remarkably well. They got a great runway of products coming in front of them, and it's had great dividend growth. So this is a centerpiece of our portfolios.
Do you know how big a piece ESPN is of the total company?
I couldn't tell you exactly what the percentage of that is.
Right.
But it is a remarkable business, and it's a juggernaut.
I just noticed a story the other day that Disney, the parent, wants ESPN to cut $100 million this year and $250 million next year, and part of that was dumping Keith Olbermann, the television personality. They built something like a $40 million studio for him in Times Square, and they realized, okay, we're spending too much, and they're going to cut back. Anyway, Disney, Apple, Concho Resources. We'll come right back with David Burrows and your questions.